Okay, so we just went over all the processes on how to completely separate our personal and business income and expenses, what accounts we need, how many accounts we need, what credit cards we need, all of that good stuff. And now we're gonna talk about how to actually pay yourself from your business, because we ain't doing this for fun. We are trying to spend the money that we are making. My personal accounts do not see my business expenses and income, and my business accounts do not see my personal income and expenses. We are able, obviously, to use the money that we generate from our business, or else, like, why would we be doing this? Because entrepreneurship is hard. However, we have to use it in a clean way. We have to let it go through the system. But first, let's go over some terms. Gross is the total amount before any deductions or expenses are subtracted. Net is the amount left over after deductions and expenses have been subtracted. Revenue, which is the same as gross revenue, is the total amount earned by your company before any expenses have been taken out. And revenue includes all of the different income streams for your business. Goods if you sell goods, services if your business offers services, monetization if you're using social media, brand sponsorships, affiliate links, if you're offering digital downloads or ebooks or courses, if you host classes, if you do one-on-one consulting. Any income or revenue that you generate in your business is included in your gross revenue. Expenses or your business expenses. Expenses are the costs incurred by your business in order to generate revenue. Here are the main categories of expenses for your business. Operating costs. Operating costs are the costs it takes to keep your business running, like utility bills or rent for your office space, office supplies, marketing and advertisement, payroll if you have employees, your website or any business subscriptions, any travel that you do for your business. Also included in business expenses are cost of goods sold, or COGS. These are the costs required to produce the goods your business sells, primarily material and labor. For my art business, cost of goods sold includes the money that I spend on my art supplies to actually create my paintings, like the paint itself, the paintbrushes, the canvases. It includes shipping supplies and postage in order to ship my products, and all the costs included in making my apparel and miscellaneous merchandise. Expenses on cost of goods sold will add up quicker than you think. A lot of times I think that we don't really track how much we are spending in order to make certain things. So if you have some really cute aesthetic branding and packaging that you use for your business, if you have your name and your logo on like tape and packing paper, all of that is included in your cost of goods sold. If you sell apparel like I do, you are paying for the blank apparel item, like the blank t-shirt. You are paying for your suppliers or vendors who are actually doing the printing for you. You are paying for the shipping and postage. If you do a custom tag on the back, you're paying for that as well. Any business cards that you include in your order, you're paying for that. And sometimes your cost of goods sold will just be what you pay a vendor or supplier to produce these things for you, and it's a little bit more straightforward, but it's a little bit more nuanced for items that you are creating and shipping yourself. For my art prints that I print at home, this includes the paper or the canvas that I print on, the ink that I have to buy, the shipping tubes, the wrapping paper, my branded thank you cards. All of that is cost of goods sold. And if you are getting items from a supplier, you have to include the shipping that you are paying to get it from your supplier to you, and the shipping that you are paying to get it from you to your customer. Don't forget that. And it's important to know these numbers so you can figure out how you want to price your product, so you can figure out your profit margins, which is how much you're making. If it costs me $22 to make and ship a t-shirt, I wouldn't sell it for $25 with free shipping, because I'm really not making that much money. Track all of these numbers so you can make the best decisions for your business. But we're not done yet. Other expenses include taxes. Remember, we're setting aside that 30% for taxes in our business savings account. It also includes any interest that you are paying on borrowed money if you have any business loans or credit cards. And it includes miscellaneous costs like unexpected repairs. If your beloved piece of equipment decides that it hates you and it just decides to break down in the middle of operations, and you gotta like stop everything you're doing and go get it fixed. Business expenses. So I know all of that sounds overwhelming and it sounds like a lot, but you want to make sure that you are tracking all of your business expenses, because here's the good thing, is all the money that you spend on your business expenses, you are spending pre-tax money. You do not pay taxes on the money that you spend on your expenses. You remember that, because it's important. If you make $100,000 and spend $40,000 on your business expenses, you are only paying taxes on what's left, which is that $60,000. That means that the profit that's left behind is considered taxable income. You got your revenue, big bucket of cash in the beginning, your expenses, some that's subtracted, hopefully not too much, and then the money that's left behind, your profit, is taxable income, meaning you are only paying taxes on the money that's left behind. That's why it is so crucial to make sure that you are tracking all of your numbers, not just so that you can make sure that your profit margins are right, not just so you can figure out how to properly price your products. Wow, that was crazy. And so that you can reduce the taxes that you pay. What's up with all these P's? That's crazy. And it's good to know how much you are expecting to spend on your expenses, and that's where budgeting comes into play, which we don't have enough time to cover in this video, but drop a pencil emoji below if you want me to cover budgeting and all things budgeting in another video. And you want to get your budget expenses as close to your actual expenses as you can, and vice versa. Next is profit or net income. All three of these terms are synonymous, they are interchangeable. Profit is the money remaining after all of those expenses we just mentioned have been subtracted from your total gross revenue. Revenue minus expenses equals profit. Doop, doop, doop. Your profit is also what people call your bottom line because it's the last line on your income statement and it's like the most important number. I don't know why I did that in the air quotations. It is the most important number. If you're in the start of your business or a rough season in your business and you're spending more than you're making, don't try to hide that on your taxes because you're likely eligible for a tax refund. Especially in the first couple of years of your business, the IRS is a lot more lenient and understanding if businesses are spending more than they're making because they understand it can take a couple years for a business to be profitable. So just make sure that you properly track all of those expenses so you can get all of those tax write-offs and hopefully a refund check while your business is getting started. I feel like I just need a giant, one of those like rip off sheets of paper or dry erase board, those like rolling dry erase boards. That would make me very official. Comment below if I should get a rolling dry erase board. Don't mention this to my husband, just comment below if I should get a rolling dry erase board. If you understand the finances in your business, you're able to make these type of smart data-backed decisions so that you can make more money, which is why we're here. This is why we're here, let's be honest. We want to make more money, but we want to manage the money. So you may be like, okay, Sunshine, that sounds cool and all, but how am I actually spending the money in my business? Like, how are these bills getting paid? How are these groceries getting bought? If I can't spend the money in my business on my personal items, then what am I doing? Okay, y'all, here's the key. Ooh. So this is the fun part. You listening? Okay. The key is you treat yourself like an employee. What? An employee? Girl, I'm the employer. I am the owner. I am the CEO, HBIC. Yes, you are all of those things. But also, you are an employee of your business as well. And you have to treat yourself like one so that you can pay yourself like one. In order to manage your money in a clean and organized way, you need to treat yourself like an employee and pay yourself like an employee. Think about a job you probably worked for before. In my engineering career, I couldn't use my company credit card to buy my groceries or get my nails done. And I couldn't just put my hand in the bonus pool and decide to take myself on a vacation to the Bahamas. I wasn't able to use any of the money from my company until they deposited it into my personal checking account. And we're doing the same thing in our business. The only way that you should access money from your business is after you've deposited from your business checking account into your personal checking account. That bridge right there from business checking and personal checking is the only connection between your business and your personals. Just like a bigger, more established company. And then you take the money in your personal checking account and you do whatever the heck you want to do with it because that's your money. So like always, I'm going to give you multiple approaches on how to pay yourself in your business because there's no one size fits all. So there's two main approaches for how to pay yourself from your business. Remember, we are treating ourselves like employees. So approach number one is paying yourself a fixed amount. You pick a salary that your business can consistently afford to pay you. You decide how often you want to get paid, whether it's weekly, bi-weekly, once a month, and then you pay yourself that consistent fixed amount on that consistent cadence. Well, Sunshine, how do I know how much my business can afford to pay me? Easy, you budget for it. And here's the kicker, y'all. Here's where you're gonna try to get upset with me, but listen closely. So we need to pick the lowest amount that your business can consistently afford to pay you. And to do that, we need to pick the lowest earning month that your business has to base your salary off of. Sunshine, I'm gonna need you to break that down. All right, I got you. So let's say in the last 3 months, your business made $3,000 and then $4,000 and then $5,000. And that $3,000 to $5,000 range is pretty consistent for your business. We're not gonna take the average, which is $4,000. We're gonna take the lowest earning month, which is $3,000, to base our salary off of. If you base your salary off of your highest earning month, which is $5,000, then your business won't be able to afford to pay you when you get your lower earning months, which you already know by data that you'll have, which is $3,000 a month. But wait, we're not done. So you're not gonna just pick your lowest earning month, which is $3,000, and pay yourself $3,000. It doesn't work like that. First, we have to deduct our expenses. Y'all remember when we just talked about all them expenses? Our lowest earning months are typically $3,000. Our highest earning months are typically $5,000. And let's say in this business example, our expenses are $500 a month. So we are taking our lowest earning month, which is $3,000, and then we deduct our business expenses, that $500. So we're now left with $2,500. Don't fight me. Do not fight me. Don't fight me. I don't make the rules. We still not done. So we're gonna take that $2,500 and we gotta set aside that 30% for taxes. Y'all remember when we talked about them taxes. So we're gonna take 30% of $2,500, which is $750, and boom, that money is set aside in our business savings account, and now we're left with $1,750. $1,750. And in this scenario, $1,750 is the most that you should pay yourself a month for your paycheck. But don't freak out, you will have an additional way to pay yourself your business's profits. So if $1,750 is what you are paying yourself for a consistent paycheck, just so that you are able to be consistent with your paychecks with yourselves, when you do have those higher earning months, those 5,000, 6,000, 7,000, we're about to claim it all. When you have those higher earning months, you will be able to give yourself an additional payment, because at the end of the day, it's still all your money. This is still your accounts, your income, your revenue to do with as you please. So we are just creating systems and formalities so that we are handling and managing our money in correct ways. So one thing to keep in mind with both of these approaches we're about to discuss is the money that you pay yourself for your salary or your paychecks is not considered your profit. We are not considering that your profit. I don't want to confuse you. You do still have to pay taxes on the money that you pay yourself via your salary or your paycheck. However, we're going to look at it like an expense. When your business brings in all that money, that's your revenue, and then you subtract your expenses, your operating expenses, your cost of goods sold, all those expenses that we talked about. You're also going to subtract your taxes and your salary, because we're all considering that expenses, and then what's left behind is your profit. So additional payments that you pay yourself when you do have your higher earning months is going to come from your profit, which again does not equal your salary. So let's do another example month with this fictitious company that we have. So you made a $5,000 month. You're subtracting $500 for your business expenses. You're subtracting or setting aside your 30% for your taxes, which is $1,350, and you're left with $3,150. And remember to deduct your salary. Your salary that we just decided on is $1,750. So $3,150 minus $1,750 is $1,400. So in this example, in the $5,000 earning month, you have a $1,750 paycheck, which is going to be consistent and fixed, and you have $1,400 profit. And there's several different options of what you can and should do with your business's profits, but we will talk about that later. And if you're wondering how a company knows how much they can afford to pay you, they budget for it and they save profit into their cash reserves. So in their lower months, they have money that they can dip into to make sure that their employees are still getting paid. If you want me to go over budgeting in greater detail in another video, remember to drop a pencil emoji below. So approach number one was paying yourself a fixed amount. Approach number two is paying yourself a percentage of your profits. This approach is better if your company is newer, just getting started, and doesn't have a consistent income yet, or if you're just in any kind of stage in your business where your income isn't super consistent. You just evaluate how much revenue you actually make each month and deposit a percentage of that amount into your personal checkings account as a paycheck. So with this approach, each month is a variable or varying deposit, meaning it's changing from month to month since it's based off of your actual revenue. So let's give an example of a business with this approach. Let's say this business made $2,400 this month and they had $400 in business expenses. They're left with $2,000. Then they set aside 30% for taxes, that's setting aside $600, and they're left with $1,400. So with this approach, instead of just paying yourself the full $1,400 remaining, I would set aside at least 10% for your profit, because you still want your business to be profitable. So if you set aside 10% of $1,400, that's $140. You then have $1,260 left that you can deposit into your personal checkings account for your paycheck. And with this approach, your paycheck, remember, is going to change. So the next month can be $700, and then the next month could be $5,500. You just don't really know because you're basing it off of your revenue and it's not a fixed amount. Until your income is consistent, your paycheck will vary with this approach, but when your income does get more consistent, I would let your profit vary and let your paycheck be more consistent, meaning like go to approach number 1. And if you are trying to do approach number 1 and you are just consistently not able to hit the numbers that you need to be hitting to pay yourself, again, you are the owner of your business. You can adjust your salary, you can lower your fixed amount, you can switch over to approach number 2 or switch back to approach number 1. You can make changes and adjustments in your business. Just make sure that you document them all very thoroughly so that you have a record of all your payments to yourself. And if you are in the start of your business, you may not be in a place yet where you're paying yourself at all. All of your income from your business may be going back directly into paying off the expenses for your business or investing in your business. Like, we all have to start somewhere. It's good to know what to do once that money does start rolling in, because it is going to start rolling in. We are claiming it. Because the moment you earn a large sum of cash or revenue in your business is not the moment that you want to just now be trying to figure out what to do with it. Get your systems in place now so that you are prepared for your big break in the future. There's also another way to pay yourself in your business, and you can use approach number 1 or approach number 2 with this, but you just are making a tweak to it, and that's the Profit First system. There's a book called Profit First by Mike Michalowicz, and it's based off of a Profit First system. I bet you couldn't have guessed that. And basically in this system, you set aside a fixed percentage of your profit before you decide what your expenses are going to be. So if you made $5,000 in your business and you want your paycheck to be $2,000, you set aside 10% profit, which is $500. You're left with $4,500, and then you pay yourself your $2,000. You're left with $2,500. You only have $2,500 to spend on your expenses. So with this method, you're prioritizing profits to make sure that each month you have your profit no matter what, and then you are making your business operate within the remaining funds. So the traditional method is revenue minus expenses equals profit. This method is revenue minus profit equals expenses. This approach kind of reminds me of like if you're working for a bigger company and you set aside money from your paycheck into your 401k automatically before you even get your paycheck. It's that automatic allocation of this money is set aside for a different reason, so I'm not even going to give it to myself. So those are actually 3 different options on how to pay yourself in your business. I hope that was easy to understand and very helpful. Like and subscribe if any of this has been helpful to you. Turn on notifications, do all the things. And the next video is talking about what to do with the profit that's left behind. With any of these approaches, if your business is making money, you are having a profit. And there's a ton of different things that you can and should do with that profit. So the next video, we are talking about what to do with the profit your business makes. Until then.